Gerald Cohen. I'm the Chief Economist of the Kenan Institute of Private Enterprise, and welcome to the Frontiers of Entrepreneurship series, Capital Ecosystems, Seeding Smaller and Regional Funds to Increase Opportunity. This is a continuation of our virtual Frontiers of Entrepreneurship conference. If you missed our January 27th event, I would encourage you to watch the recording and read the associated Trends in Entrepreneurship report. We'll put a link in the chat for those. In that report, Martha Legg-Miller and her team illustrate some of the challenges to creating a more inclusive early stage capital ecosystem. Our discussion today will elaborate on those issues, coming from some of the foremost experts in the field. Martha serves as the SEC's first director of the Office of Advocate of Small Business Capital Formation. The office advocates for solutions to address challenges faced by small businesses and their investors raising and deploying capital. Prior to joining the SEC in January of 2019, Martha was a partner at a law firm practicing in corporate and securities. In December 2021, the office delivered a report to Congress outlining the state of capital raising activity and policy recommendations. One final housekeeping issue before I turn the floor over to Martha. We will be leaving some time at the end for audience questions. Please put those questions using the Q&A button at the bottom of your screen. Thank you and welcome again.
Thank you very much, Gerald. I am thrilled to be here today and appreciate those who have dialed in to join us. We have a fantastic panel here today to talk about really wonderful and timely issues impacting access to capital in different communities across the country. Rather than me introducing the panelists myself, what I would love to do is to turn it over to each of the panelists who are joining us today to give a very brief 90 seconds-ish introduction. And if it works, we've got Marianne Feldman from UNC Chapel Hill, who is the Henninger Distinguished Professor and Faculty Director at CREATE. We've got Brent Comstock, CEO of BCom Solutions, and we have Shana Ostrovitz, Executive Director of 1909. We'll turn it over to our speakers to briefly introduce themselves. Then I will dive in and share a few slides from the Trends report on some data that will inform the discussion, and we will dive right into the Q&A conversation. Panelists, are you ready to jump in and introduce yourselves briefly?
Hi, this is Marianne Feldman. I'm not able to share my video, but I am a professor at UNC Chapel Hill in the Department of Public Policy and also in the finance department at Kenan Flagler Business School, and also work with CREATE at the Kenan Institute. And we say CREATE is about creating data to create policy, to create prosperity. It's my pleasure to be with you today.
Thank you, Marianne. Brent, are you able to go next?
Certainly. Hello, everyone. Brent Comstock here, joining from the great state of Nebraska. Excited to talk about rural investments across the country. Most importantly, a proud UNC alum, graduate of Kenan Flagler's Business School. And right now I'm running a consulting firm, BCom Solutions, that does a variety of different things, but a large focus on promoting and engagement of businesses and organizations growing in kind of the middle part of the country and rural parts of the coast as well. So excited to be with you all and talk more about this subject matter.
Wonderful. Shana, can you round us out?
Absolutely. Hello, everyone. My name is Shana Ostrovitz. I'm the Executive Director of 1909. The 1909 Foundation, we are a nonprofit organization in West Palm Beach, Florida. And the leadership of the organization, including myself, started as entrepreneurs here in this community at the very, very early stages when there were no resources and support, and essentially created this organization for creators by creators. We now serve over 200 entrepreneurs and small business owners in South Florida, providing them mentorship, education, resources, and support, especially around capital. So I'm very happy to be here.
Wonderful. Well, I am thrilled to have these three different perspectives join in for what I think will be a wonderful conversation. If the Keenan team can cue up the slides, wanted to share a few data points to ground the conversation as we get started today, because I think that the trends report, for those who have not downloaded it, there is a link in the chat, but would encourage you to take a look at that. And we're going to highlight a few of the slides shortly on screen. All right, so there's our lovely title slide with a riff on the cover of the Trends Report. If you can go to the next slide, Sydney. Thank you. So want to highlight three notable trends that you're going to see reflected in the data and that I think will inform the conversation today. The first one you may be familiar with if you've been following the news, and that was that we had a record year in 2021 for venture capital fundraising, investments, valuations, IPO activity. But those headlines don't tell the full story because they are skewed by some really large outlier numbers that in many instances leave behind so many people in other areas of the country who are not captured by that big boost in activity that we saw. Early access to capital remains highly localized. And so we have still continued to see that when you are raising capital early stages, you're raising it from those who are nearby in your community. And that has exacerbated us seeing some really big hubs with capital raising activity, and then a much smaller proportion of capital for entrepreneurship dispersed elsewhere in the country. And last, but certainly not least, we are seeing that underrepresented entrepreneurs, especially women and minorities, raised record dollar amounts, nominal amounts last year, but proportionately to their peers, actually raised less capital. So in other words, the rising tide did not lift all boats equally. So want to dive in and hit the next slide, and we'll start looking at some of the data. So if you look in the trends report, you will see that angel and seed activity was on the rise in 2020 and 2021, particularly when we're looking at the deal value, which you see listed in the bars. Next slide. Similarly, we saw that venture capital deal values surged in recent years. This is data as of June 30th, 2021, when the final numbers came out at the end of the year. It was a record-breaking year by all measures, both deal count and deal value, looking at the companies that were receiving funding. Next slide. One of the interesting trends that we saw underlying some of that surge in venture capital were that non-traditional investors, think your folks that are normally investing in the public markets, maybe your sovereign wealth funds, your mutual funds, those who aren't a traditional venture capital firm, they were driving many of these shifts in valuations and deal size, often looking for some of those pre-IPO deals that they could get in on before that company goes public. And those large deals inflated the overall numbers that we see on the venture capital fundraising space. Next slide. Early stage capital we've seen remains highly localized. One of the statistics that jumps out at me every time is that the distance between a lead investor and the target company in an angel capital deal remains only about 37 miles, and that radius has not been growing. And that is in large part because of the nature of these ecosystems where funding is going to companies that are close by that those investors can then mentor and help grow. We also have seen that the location of the early stage investment activity is also very correlated with the areas that have later stage capital raising activity. In other words, angels are investing close by where there is then subsequent capital that can help those companies grow. But one thing we did see last year is that more than a third of angel and seed deals occurred in areas that are not the top 10 funding hubs that you're used to hearing about, whether Silicon Valley, Boston, New York, Austin, et cetera. So that is a really positive sign for some of the ecosystems that exist with wonderful companies and investors in other areas of the country. Next slide. We also have seen, and Brent was mentioning, a passion for rural capital raising activity, that rural businesses still are lagging metro areas. But when those companies do go out and seek capital, we're seeing increasing success that they are finding. So some interesting trends that we are spotting with the average size of deals that we are seeing in rural communities. Next slide. While venture capital soared to record heights in the last year, underrepresented founders were raising a smaller proportion of venture dollars. So what you see on this screen, and this is all of these are in the report if you want to dive into the data, really showing that the proportion of representation doesn't reflect the larger population. So we see women-founded companies, only 2.3% of venture dollars actually going to women-only founding teams, which was a decrease from 2019, and 10.8% to women and men co-founding teams. Likewise, we still see that minority-backed companies are raising far less capital relative not only to population statistics, but also to rates of business formation. So a lot of work needs to be done on this front to bring some of this access to capital and funding to parity. Next slide. And as I was mentioning, this largely reflects the composition of who is making decisions. We know that women and minorities are underrepresented among decision makers, both angel investors as well as the investment partners at venture capital firms. And that has ripple effects in who ultimately receives capital. All of that said, there has been some recent progress, particularly following 2020 and the racial reckoning that we have all been looking at and grappling with. But there is a lot more work that needs to be done to get us to, I think, where everyone would like to see parity in access to opportunity. Next slide. So these changing trends in who is receiving funding requires us to examine a number of trends in who's allocating funding. I was highlighting that earlier. I won't reiterate those here, but these are critical areas, including areas for future research for those academics who have joined us today and are looking for that next project to dive into. Next slide. We'll skip over the expert insight that features yours truly. You can read about that and the references. In this last slide, I will encourage you to download a copy of the trends report. This is only one section of that document. The link is in the chat, and encourage you to take a look because there is a wealth of information there. And with that, we're going to wrap up the slides portion and jump right on into the conversation with our panelists who are going to rejoin me on the virtual stage. If you are ready to kick off, Marianne, I'd love to start with the first question directed over towards you. Marianne, we know from the data that the vast majority of capital is raised in a handful of metro areas. What do you see as the most significant barriers to accessing capital for entrepreneurs and small businesses in other areas of the country? And, how and where are those businesses finding their investors?
I think that there's a tremendous amount of experimentation going on right now, Martha, and it has to do with this sort of surge in disposable income that people have. So when we look at places that are getting venture capital, angel investment, and then of course, venture capital seems to follow angel investment, one of the things that we see is this tends to concentrate around college towns, right, and university tech transfer. So universities have done a great job of building out local ecosystems and attracting more venture capital. I'm interested to hear from Brett about what he's observing. But I have seen this movement in places, and you mentioned a sort of rural entrepreneurs are disadvantaged, as are women and minorities. And if you are a woman and minority in a rural area, you are very significantly disadvantaged. I just interviewed someone who was part of a farmers co-op in Alberta, and they decided that they would form a venture fund. And, this was unprecedented to me. And they're investing in ag tech, which they know, and they're investing in Alberta. And I thought that that was such a sort of positive move forward. The farmers are a little nervous. First of all, they feel they know how to evaluate risk. And they know as farmers that you have long-term, you can't expect short-term returns. But still, it is a new area for them, and it was just exciting to see this energy in trying to promote what would become a pillar of growth in their community.
That's a fantastic insight. And I love hearing examples of those who are trying out new models or who are pioneering and breaking in, because one of the themes that we're exploring today is really looking at the rise of regional funds and pooled capital and the impact that that can really have on those ecosystems. Shana, I want to turn it over to you for our next question. You are supporting a number of small businesses through 1909 in West Palm Beach, Florida. Most people associate Palm Beach with a sought after vacation destination. Yet in spite of so much wealth being in close proximity, you've seen some challenges with founders not accessing the capital they need. Talk to us about the dynamics of regional capital from your perspective.
Yeah, absolutely, Marian. I think it's such a good point. Anytime people think about us from the outside world, it's like, oh, that's where people go to retire and vacation and all the snowbirds. And there's a lot of truth to that. However, where we are, it's been growing a lot. We have a lot of young talent and creativity and businesses up and coming. And, I think one of the biggest challenges we've seen, and I think it's very related to, why certain markets do very well with funding, is that most of the people that are here with capital, I mean, this is, right across the bridge from us is probably the wealthiest people in the country, is that their businesses and their wealth actually came from a different type of business or a different type of transition of money than the people creating businesses today. And so there's quite a wide divide between what people are creating in their businesses today, the technology that's up and coming, and what the people here with potential ability to invest understand. We've seen a lot of our founders here having to really explain, what the types of technology investments could be, the opportunity for growth, the risk association. I mean, it is, they look at the risk profile compared to, for example, real estate. And it's very hard to have that conversation and help people understand what it means to invest in, an early stage company. And so we've had a lot of education going on here. I would say the past, 5 to 10 years has been heavy education of potential investors and what that could be. And we've seen a small shift. And actually what the biggest shift has come from is we've saw a large number of people moving here from New York during COVID. And a lot of those people had been involved in more of the companies and types of companies that you see today, had more involvement in investing, had more involvement in making their money through that type of venture. And so we're seeing a spur of energy and interest in companies here, which has been really great. A very silver lining to a crazy event happening across the world that, but it's been interesting to see kind of that social proofing from investors from a market that sees a lot of early stage investment coming here and just starting to do that. And kind of the domino effect of people who have always been here with the funds, but just didn't exactly know or weren't in that type of environment and culture to do so. And so we're really right in the middle of a huge shift here. It's kind of interesting. It's exciting because we've been here, and it'll be interesting to kind of see what continues to happen.
I think that's a great point that you make, that the wealth and the resources of a community is not necessarily correlated with its inclination to support a new generation of entrepreneurship, not because of malice, but because it is a different skill set. It's a different perspective when you're thinking about supporting entrepreneurial ventures. Brent, I want to turn it over to you for our next question. You have focused so much of your work on rural entrepreneurs, working to connect rural communities to other communities of capital that may have more of those resources or investment experience, as Shana is just highlighting. Talk to us about what it is like to raise capital in a rural community.
Sure, absolutely. Well, it's great to be with you all. I think maybe the first thing is to identify what is rural, because So I grew up in a town that had a whopping 2 stoplights. And so for me, rural was like 100, 200 people. My parents grew up in towns that had 300 people. But to people that are in this space, rural is really anything that's not San Francisco, Bay Area, New York, and Boston. And you're starting to see that change, right? Like, and with COVID, you started to see people that went home to see their parents and have not yet left, where they went home to see because they could, get a better value on a house, or there was green space and they weren't cooped up in an apartment or a condo in a major metro area. So when I think about rural, I really think about less geographic and more size, and also just kind of competition for resources. Obviously, rural California looks different than rural Nebraska, but in the Midwest itself, like 40% of Fortune 500 companies are based in the middle part of the country. And so when you think about where is the commerce and activity taking place, I think COVID did a really interesting thing for people to recognize. Obviously, a horrible thing from a health perspective, but for people to look at where can you achieve success from a business and commerce perspective, has really incited some interest in developing rural communities and the rural venture capital ecosystem. Still, though, to the point of the conversation here, the biggest challenge in raising money in the Midwest, whether that's Omaha, Lincoln, whether that's in Oklahoma or Kansas, or even parts of the coast, once you get that money too, you've got to be able to supply it with talent pipeline, right? And you've got to be able to grow those businesses. In Nebraska, we have a 1% unemployment rate. So it's kind of hard to find people once that money comes in. But what you do see is you see people that have moved to the coast that are interested in investing in their hometowns and their communities. They might not be a lead investor, but they might be working in New York or San Francisco or some of these other places, and they think they can give back, so to speak, to the ecosystem in their communities. And I think that that's really important. I think it's also really important to recognize that all the money that's being invested into the country from the government's perspective, both in the previous and current administrations, a lot of that was put into rural broadband, which maybe isn't a subject for venture capital on the coast. But what that means is there are now places across the country that previously couldn't do anything with the internet, literally nothing, that can now build billion-dollar exited tech startups in the middle of the country that just didn't exist before. So it's definitely shifting, and it's I think shifting for the good.
So can I ask you a follow-up on that, Brent? So you're talking about people that are maybe have moved away, but they have a nexus. I'm an example of that. I'm in DC now, but my heart is still in Alabama, which is my home state, which meets just about every definition of rural, unless you're looking at maybe the 3 large metro areas in the state. But how are investors who aren't in the rural communities finding those rural investment opportunities from outside of the region? What are you seeing, Brent?
Yeah, that's a great question. One thing that I think we maybe underestimate is the diaspora community of when all these people are leaving rural communities when they grow up and go to college. Where are they going? They're going to New York and San Francisco. And so I think there's a large capital, human capital base that are in these major metro areas that still have some connection to home. And so they might see a story about something from home. They might see a story about a company that's growing. I do think that the regional venture capital funds that have been created, and I worked on a regional venture capital fund in the Baltic region of Europe right out of college from UNC. So definitely not Nebraska, but the same effect, where all of these smart people were leaving their communities to go to the epicenter and the hub. And at some point they asked the question, well, can I do the same thing in the place that I call home? Probably for a more economical value as well in terms of expenses and cost of living. So I think that that's one area. And then the second area that I think that where people are finding these opportunities in the Midwest and across the country is the remote employment base and just growing these ecosystems. Like, we have employees in 4 time zones, yet our company headquarters are in Central Time. Why do we have employees in 4 time zones? Mostly because we couldn't find employees in the Midwest because the unemployment rates are so low. So we started to add people that worked remotely. They know people, and that thing kind of spreads. The one critical feedback that I will say that I think people in the Midwest are humble, wonderful people, sometimes too humble, to the point where we're so focused on just building our little regions that we don't sound the alarm of how great things are going. And I could do that all day, but I won't bore you all. But I think that that's a really great opportunity for people to start looking at people in the region. And you see things like the Rise of the Rest competition that the Steve Case Foundation and his venture capital arm have done. There's competitions like that where people are coming from the East and the West Coast to the center of the country. And the more that we can do that, I think the more that we can kind of break down this barrier of the rural, urban, coast versus Midwest divides that exist.
Well, that's a great segue into my next question for Mary Ann. You have studied and written a good bit about the geography of innovation. In fact, that was the title of your dissertation. Let's talk for a second about some of these regional entrepreneurial ecosystems and really zone in not on that traffic between others, but looking at the mix of who exists within those. How does the local mix of entrepreneurs, investors, larger businesses, and other market players impact access to capital? And specifically, would love for you to highlight the emergence of funds that are investing in those entrepreneurial ventures.
Oh, great question. And actually, I think that the best way to understand this, so, we think about entrepreneurial ecosystems, so having all of the actors in place, but really this develops as part of a process. It's a temporal process. And so in the early stages, when a place is trying to build capacity, you can't attract venture capital because you don't have a critical mass. And so there's not sufficient deal flow. And so that's where government investment becomes really important. And I think, the role of the Small Business Innovation Research Program, the SBIR program, is very foundational in really helping businesses get this non-dilutive investment that then helps them develop some capabilities and interest. And so, as an area sort of develops, we can think about the critical mass. I mean, I love Shana's description of what's happening in West Palm Beach, right? And sort of these things start small and the number of firms increases over time. You develop a critical mass that then makes it easier to attract subsequent investment. I love that we're focusing on this sort of diaspora, the talent diaspora, who have an attachment to place and are willing to make investments. And we see also that cashed out entrepreneurs, will come to places, will stay in places, and then reinvest. And so, I think it has been described to me at first, you can't get venture capitalists to even look at your companies. And then once you've had some successful exits and you've demonstrated you have good technology, you're sort of beating them off with a broom. And I think very few places are in that fortunate position. But, this is sort of how this works, that venture capital, we would hope, was scanning the horizon and looking for the best investments. But, venture capitalists tend to go to places they can get to easily. They tend to invest in technologies that they know. And I think another kind of diversity we have to worry about when we think about financing small business is the diversity of technology sectors that investors are willing to, where they're willing to put their money. And so it would be great to see more of that kind of diversity. And, in my early work, I sort of found that we had these ecosystems that developed around specific technologies. Part of what is inhibiting us right now is we don't have strong anchor firms that are specialized in technologies. So we've lost so much of our manufacturing base. that we don't have this sort of differentiated landscape. So to me, it's really exciting to see the new initiatives that are making their way through the Senate and now the House and in reconciliation, where we will see this big push for investment and for reshoring American manufacturing. Because I think that those sort of expertise then creates opportunities for entrepreneurs to fill in supply chains and to innovate around existing technologies.
I think that those are great points, Marianne, and it's reflective of my own experience being from Birmingham, Alabama. People didn't have a background in investing in startups, and it wasn't, and nor were venture capitalists coming and knocking on the doors of the really great entrepreneurial ventures that might have gotten SBIR funding or have figured out a way to bootstrap or raise some of that seed capital. And it wasn't until there was a turning point when one of the companies had a $500 million exit that people said, wait a minute, someone built a company that sold for $500 million in the middle of Alabama. I need to pay attention to this tech company and this ecosystem. What it also did is it created a number of founders and early employees who had equity. And all of a sudden they had cash and they had friends that had gone out and built new companies. And so it started this flywheel effect that was really impactful. Shana, I would love to hear your thoughts on how you see these entrepreneurial ecosystems and funding networks existing in West Palm. What are you seeing? When you talked a little bit about the evolution of how it's changing right now, tell us a little bit more about what that ecosystem looks like.
Yeah, I mean, it's so interesting right now here in South Florida because we have just had so many major shifts happening. I think we're a really good example of a regional ecosystem that up until just recently had been very divided. So we had Miami down in the south, which was, somewhat of a booming and happened earlier in terms of entrepreneurship, innovation, and investment. But a lot of that, again, was focused on, what was being done for Latin American markets and wasn't really coming up north to where we are. So, there's about an hour and a half difference between where I sit and, the hub of what's going on in Miami. And then about 45 minutes in between both of us is Florida Atlantic University, which is probably the one major university that would be considered for a talent pipeline for both of our ecosystems. And, it was up until about 5 years ago very divided between our three communities, and we had different accelerator programs going on and mentorship programs and events and things like that. And what's been really wonderful to see, and I have to give a lot of credit that those of us in this ecosystem have really taken a commitment to collaboration. And we've had a train installed that goes literally, it's called the Bright Line from here to Miami in an hour, and we'll stop in Boca Raton soon, to really blending the region. So we have shared events together. We've done a lot in terms of sharing mentors, which I think has been hugely impactful, because if there's a mentor working with a company getting funding down in Miami and they're working with someone up here that might be of interest to somebody coming in for funding, they're going to know that company, they're going to be able to bring them in. And so that has been something that I think has really been an advantage that has just started to grow in this ecosystem, is the sharing of resources where possible, although it might be hard to get from city to city, and some of the focus areas from in West Palm Beach, we have a bunch of prop tech, right? Property tech companies. They get it. There's tons of real estate going on. It's booming here. All the technology here, there's a lot surrounding that. We're seeing a ton of that. And then down in Miami, you have a lot of crypto. And again, focus on technologies that will support Latin American countries and the growth there and bringing Latin American countries here. And so there is somewhat a divide, but that's, in a good way. We have kind of our focus areas, but then we can share resources and events and things like that really connect us, which I think has brought a ton of value to this ecosystem and growth across the board. And one thing I would say too, especially about mentorship and events and things like that, is being able and learning how to do those things virtually has been very helpful. Again, so we have a lot of mentors that serve our members and entrepreneurs here that are based in Miami, same way around. And again, they kind of bridge that gap and know what's going on. And so kind of back to the point that you're asking, Brent, of how do funders know about those companies? We're seeing a lot of times the mentors that are serving across cities are creating those opportunities when, they're talking with funders or supporting with funders and for entrepreneurs in certain industries. So it's been really wild to see the change here. I mean, again, when I started my company here 6 years ago, we were like listening to podcasts out of Silicon Valley and being like, that's not at all what it's like here, like, and trying things that did not work. And just, it was so different. And we were kind of so alone and clueless. And we were just trying to, again, teach people what a convertible note was. And it was just so interesting. And now it's just this much more connected and collaborative community. And we're definitely, all of us are seeing the benefits of that, which is really exciting.
That is very exciting. Well, you started talking about convertible notes and trying to educate the investors. I want to switch into looking specifically at the role of the investors in these entrepreneurial ecosystems. Brent, question for you. When you look at the capital that is backing businesses in rural communities, are those investors primarily local? Who are those investors that are backing those companies?
Yeah, great question. Well, I think almost always there's some local component involved, and whether that's in a town, local meaning a town, or local meaning if I'm building an ag tech company in Nebraska, I'm probably looking in Lincoln and Omaha, Kansas City, and Chicago for investment. But I think there's often regional funds that are available. I know in the Midwest in particular, Crunchbase did this report, it was probably a year ago or so, with Dundee Venture Capital. It's based here in Nebraska. And somewhere in the report, I don't have it in front of me, but somewhere in the report they talked about, like, there's like 100+ regional funds that have been created in the Midwest in the last 10 years. Now, a lot of those are seed-based, but they're locally driven. So they're the entrepreneur who had an exit, who put in 5 million and has grown the fund to 60 million and added on more LPs. Or there's someone who left the community and retired back to the Midwest and now wants to contribute. Or there's someone who just happened to want to do that and just created that because from a regional perspective, it's a lot easier than saying just one local piece. But one of the things that I have seen as well are local funds that are also now specializing and creating specialized funds. We talked a little bit about that. I know in 3 or 4 states here in the Midwest, the angel networks that exist in these states are now creating angel network for ag tech, angel network for fintech. And I think that's a really good sign that we're specializing further, because when you do look at the funds on the coast that invest, they're here. They're typically not leads, and they're typically investing either more seed-based or they're more institutional based, like an NEA or a Graycroft or someone like that. But they're here, but they're not taking the lead. And so finding those specialized regional funds in a specific area that can then go find their counterparts that might be interested in tying on in a round from the coast. That's really what we're seeing as success. Another thing that I'll just add on for the really rural components, we talked about some of these businesses where, in rural Alabama, a company sells for $500 million, then everyone swivels their head and says, what in the world happened? So many of the businesses and companies in the Midwest that are the most successful, that would be ripe for reinvestment back in the community, they're family businesses. And so even, you have family farms, that's one thing, and an obvious thing for the Midwest, but there's a number of machinery, equipment, implements that are easily doing 60, 70, 80 million a year, that are regionally based, that they wait until X parent becomes 65, 70, and then it's just natural that it happens, that it goes to the next person, and you're starting to see a little bit of that where the younger person, the next generation, leaves. And so like, well, now what do we do? And so you're starting to see some of that, where that investment in the community, people say, oh, well, we could sell this and have something to invest back into our communities. So a lot of cool things happening.
No, definitely. And I think that the points you raised in the Crunchbase report, it's a great report. I think it's called The Mighty Middle, talking about the country. But it really goes to the importance of having these sophisticated pools of capital that give diversified exposure to the investors, but that also bring in the relational networks with other investors from outside of the community who come in and syndicate together. Because a lot of those coastal funds are not flying back and forth, whether it is to Nebraska, Alabama, or West Palm to go diligence deals. But if they've got a network of relationships with a sophisticated early stage or later stage fund, that does bring in some of that capital from the coastal hubs in a really supportive way for that local ecosystem, and makes it where you don't have to have a mega fund located in your community. You can have a smaller or mid-size regional fund, but that serves as the deal anchor for others. Along the lines of talking about funds, Marianne, I would love to hear from you. What do you see as the barriers to entry for new and emerging fund managers to start and to launch a regional fund?
Oh, I think it's the startup problem, right? For every, sort of small, every endeavor, right? And so it is the credibility. It's exciting to me to see younger people getting involved in this. And, so I think there are, the issues of just getting started. I think that, Martha, here's where we could see states trying to make it a little bit easier and providing, some additional sort of supports. We have a trend where many state economic development agencies are privatizing, or they're going to quasi-public status, right? And so that has happened in North Carolina. It's happened in quite a few states. And the emphasis there is not on small business, but it's on relocating, sort of big companies. And that's really unfortunate that there is no sort of state entity that focuses on entrepreneurship. We talk a lot about entrepreneurship, but do very little to sort of address and remove these barriers. So I think there's just the problem of getting started. Success begets success. But I think that there is just, tremendous opportunity.
Agreed. And that's a wonderful opportunity to also plug and make sure that people are paying attention to the State Small Business Credit Initiative, which is the $10 billion program that Congress passed and Treasury is in the process of implementing. 30% of that, so $3 billion of that, is going to go to back state and tribal-led venture funds that are investing in local businesses. So it is poised to be the largest infusion of capital into entrepreneurial ecosystems across the country. And I think that will be not only phenomenal to watch in real time, but it will make for fascinating research looking at the impact of spurred capital being infused into different regions everywhere. So I'm very much excited about that and seeing how the different states convene programs. Just as a follow-up question to you, Marianne, what impact do you think that you're mentioning excitement about seeing some of these younger and newer investors? What do you think that these new voices, what is the role that they play in regional transformation coming to the table as investors?
Oh, it's a great question. So I do think it is, first of all, I've been impressed by this attachment to place, right? And to growing in place. And so not relocating to New York or San Francisco. And I think that, the sort of younger generation has really faced, kind of a different situation, and are concerned about social issues, income inequality, and things like that. And so are really rolling up their sleeves to try to build things. And so I think it's a new perspective on, I want to say more socially responsible, right? Rather than just looking at the ROI. And I think that that is also, sort of very positive.
Yes. And I'll give the flip side of that. Shana would love to know, what are you seeing with some of these newer investors, or maybe people that are seasoned investors in the real estate space or in a different space? Do you see people bringing a different perspective or different view to West Palm when they are becoming startup and early stage investors?
Yeah, I mean, I think again, there's a lot of kind of education transformation happening right now. I would say generally, you know, the perspective and risk profile is much different from people who have not been in, you know, more of the tech space, high growth capital investing before. However, I think there is, you know, the benefit to that of challenging some of the business models we've seen in the past 10 years, especially around this kind of like unicorn growth concept that has received a lot of investment. And I say that because, you know, a lot of those business models have shown now in the later term to have lots of challenges, to have issues with consumer data, or, you know, selling consumer data, the advertising model of the, you know, high growth user base. And I think some of those more traditional investors that we see here that, you know, weren't a part of that initially do question that a little bit more. And I think in a good way. I think they push businesses and entrepreneurs to think more about their business models and how they're going to make money and how they're going to be profitable more quickly. And I personally think that's a benefit. And I think we'll see the shift of that, you know, business model going back to, you know, more business models where you see people trying to earn revenue more quickly, a more steady growth trajectory that's a lot more sustainable. And I think entrepreneurs are frustrated with that a little bit because, you know, a lot of those new ones have been raised and brought up in the culture of this, you know, grow as quickly as possible, you know, regardless of the long term. And so I think we're shifting back towards some more of those, you know, quote unquote traditional business models. And I think we're seeing a lot of different business models with blockchain and community owned businesses, which is also a wonderful thing. So I just think it's interesting. I think those questions and perspectives are really beneficial to chat some of the, you know, more recent culture we've seen around growth and investment and what businesses should be trying to do in their early stages.
Excellent. So question for you, Brent, before I get to a question for the entire group and we switch over to audience. So Brent, do you think that some of these smaller regional funds should be using the same metrics for success as the mega funds of Silicon Valley or New York? Should their limited partners have a different expectation? Should they have the exact same? Tell me, what do you think? What are you seeing?
Yeah, well, this is certainly my opinion, and I'm not biased at all. Living, you know, in Nebraska, you know, I'm clearly, I've fully embraced this. I think the answer to the question is that they should expect what you would expect from any other deal prospecting and investing process. You want good diligence, you want a sound strategy, you want a good team. An idea is nice, but you want a business that's going to grow, that's going to scale, and that's going to look for an exit. And I think the more that we try and silo different categories, whether it's geographic, whether it's the size and scope of it, the more we're just going to keep building these barriers that exist over and over and over again. Someone asked a question, I was just scrolling through the Q&A about rural and inner cities are very similar. And the answer is yes, they're hyper-local. Women and minority-owned businesses are often roped together, although those are two very different issues, but it's the same challenge from the perspective of if you have geographic constraints, that's an issue. There's all of these different things that we could find for reasons to change or to make it easier or to make the narrative like, well, yes, but. And I'm a big believer in, you know, I sit on a couple of boards of companies that funds we've worked in have invested in. And I always ask for metrics and numbers relative to where the company is and where the industry is, not where the nearest competitor geographically is, not where, you know, all of these different people are. I realize that that's not always an easy and black and white expectation, but we do have to find a way to stand out from the perspective of like, we want the same thing that everyone else wants, which is to build a great business, hopefully with a great team, to develop an ecosystem that's successful. And I think there are many ways that you can say how regionals are different than these national ones, and I'd be happy to talk about that. But from the perspective of should LPs go into this and investors go into this looking at it differently, I think if you go into it with your expectations lowered, which would be the case that many people would assume if it's a smaller entity, then you're just overall not going to have the same sort of engagement and return that you want. I've debated that with a couple of other people in the past, but I think that's speaking from the bottom up, so to speak, of trying to say from Nebraska to the coast versus the coast to Nebraska. We can punch above our weight, and we can do just fine with everyone on the coast. And we just are continuing to do that. We see that over and over and over again now.
Well, I think that is a fantastic segue into the Q&A. You started hinting at the Q&A that we've seen. Gerald, I'd love to invite you to join us and to bring some of the audience questions to the floor for this group to answer. So I'll turn it over to you to moderate this portion, Gerald.
Thank you, Martha. Yes, there are some great questions in the chat, and fortunately, Brent, and we have limited time, so fortunately, Brent addressed one of them. So I'm paraphrasing them, so apologies if you asked a question and you see a slightly different question that is asked. The first one is, this is a bit of an economist take on it. Are VC returns from the kind of non-top 10 hubs different than the top hubs? And if there are return differentials, how much of that is driving the investment choice? And is there something that we could do to kind of equalize those differentials?
I think that, again, sort of what is a good ROI for an investment? And Silicon Valley has expectations, but for people who look at maybe the stock market or the interest rates, right, that they're getting from their different accounts, the idea of investing discretionary income in a company is attractive. And so, I think that we see so many VC investments don't make a lot of money. And if you could really predict perfectly, but I think that we do get, again, these are such skewed distributions and skewed valuations. So to sort of talk about averages misses the excitement that happens when we have a $1 billion exit in Provo, Utah.
I just taught my students about skewed distribution, so it's a very important concept. Thank you, Marianne. Any other takers for that question? So a second question is, what is the role that investment clubs and independent financial advisors who have close ties to the community but may have regulatory hurdles play? Or what role can they play?
One example from a small community where obviously the financial advisors, the investment professionals that are bound by regulations I've seen this play out and pan out. I think one very easy way that some of these clubs and groups can provide guidance is in just education and in putting themselves into that community as well. Oftentimes the investment professionals are sitting behind a desk typing and managing portfolios, but if there's a local business small group meetup, or if there's an investor club, or if there's an incubator, an accelerator, oftentimes people from perspectives of knowledge and power wait for the invite, but kind of flipping that the other way to just be a sounding resource is really helpful. The other thing that I would say is if they're not constrained by regulations, having one of those individuals that has that knowledge on a local economic development board or a startup association board, whatever kind of the thought leader is in the community, as long as they can be on it, they might have to just not answer every question or remove themselves from certain conflicts of interest. But that perspective I've seen is really helpful in groups that engage them.
I'll also add to that, since we're asking a lovely regulatory question, that the question asked really gets into a number of interesting aspects of investment advisor regulation and the types of products. What I'll say is, zooming out, I think the most important thing is for the underlying investors themselves to have a really good sense of the skills to evaluate these types of deals, because it's very different than public market investing. It's very different than going into a brokerage account or asking your investment advisor to put you into a couple of different mutual funds, that if you decide you need to sell them because you need to make a down payment on a house or there's an emergency, they're highly liquid. It's a very different ballgame when you're investing in early stage companies, and it's really critical for the investing community that wants to back them, whether as angels or as investors in a fund, to have the knowledge and the tool set. We have a number of tools available through the SEC, but it's critical to have that educational base for them to be prepared for that.
So I'm going to try to squeeze in one more question before we go back to Martha for a lightning round. So Brent, you kind of addressed part of the question about urban underserved communities versus rural, or that they aren't different. But are the policy prescriptions any different for what people can do, what investors can do to kind of help both of those communities, or is it the same?
That's a great question that I am not even marginally close to qualified to answering. But I do think that there are a good number of policy matters that have variation, probably no more than if you're doing national versus international, or think about it in terms of any different scale and scope. I think that there certainly are, and I would say that probably rural and maybe the more Midwest and less hyperactive VC bases probably have less defined policies. I think that's growing and changing, but they haven't been doing this for 65, 70 years. But that, in my experience, that's been the case.
Thanks. I'm going to turn it over to Martha for a lightning round.
Yes, thank you very much, Gerald. Appreciate it. And I know we couldn't get to all of the questions, but appreciate those for asking them in the chat function. And certainly there are policy suggestions for those who are interested in the policy angle in the trends report. Want to ask a lightning round for each of our panelists. And just wrapping up, as you know, there is a lot of data out there on venture capital in the top metro funding areas of the country, but far less on the ecosystems where the vast majority of entrepreneurs and their employees live and work around the country. So in closing, I would love for each of you to go around and spark an idea for future research from our audience that ties in with today's discussion, and we can go in any order. So jump in and share. What does someone need to be measuring and understanding to better paint the picture of what capital raising and entrepreneurship looks like in different communities?
We're always looking for better data, right? And right now we've seen that there are lots of new business formations, and that's as recorded by the Secretary of State. Lots of people filing for new incorporations, in sort of understanding how this is going to move forward. We don't really have good data on entrepreneurial support organizations, right? The various accelerators and different programs that contribute to ecosystems. And so, again, as an academic, always wanting more and more data. We know a lot about venture capital investment, but, to sort of track companies over time to see all of the touch points. Many times we don't realize all of the pre-investment that went in before there was a VC investment realized. So, SBIR, university programs, and then that sort of 360-degree contribution.
It's a great suggestion.
I'll jump in. Oh.
Yeah,
From like
go ahead.
my view and lens of the ecosystem kind of builder perspective and the accelerator perspective, because we talk about data a lot, especially in early stage, because so limited, right? Number of jobs, revenue, increase in those things. It's very, very challenging to track that in the very early stages. And we generally do our best, but it can be hard to use that data to actually inform what is the long-term benefits, what are we seeing long-term? And so some of the things we've started looking at, and I think, is valuable, is really tapping into the educational accelerator programs, innovation hubs, and really understanding how many of the entrepreneurs and innovators are taking advantage of those resources. And then year over year, what is their growth and are they staying in that market? And that's something I think, especially for the smaller markets, is really important, because I think that's when you'll see, do people have to leave the market at a certain time period to find the resources and capital that they need? Are they able to stay? And if they are able to stay, what happens at that point? Where are they getting funding and talent and all those things from? So it's really kind of at that point in time when, where do the resources and support run out essentially, and how long can the founders stay in those local markets and really continue to thrive? Because I think that's a big crux of how our ecosystems, smaller ecosystems, develop, is we want those companies to stay and thrive and exit and redistribute the capital back into the community. But it's kind of that chicken and the egg. If the resources aren't here to do that and they have to leave to another market, we can lose that. We can lose the potential funding and connections back. So it's a challenge for sure. I think from a data perspective, I'd love to be more involved in that, just to be honest, because I think there's a lot to be learned and tracked around that.
Great suggestion. Brent?
Yeah, I get two quick things. One, I'm always interested in people, companies, and things that don't get funding, don't receive support, that to learn from. I think oftentimes we're so focused on building and growing that. And I think in a lot of these regional funds, there are people that are ripe and available for investment. Either they're not applying for it, i.e. family-owned businesses, generational businesses that are more bootstrapped and more profitability focused versus venture growth focused. I think that's one area that I'd love to dig more into. And then the second thing really has to do with the talent attraction. And I don't know how you do this, but finding a way from a data perspective to figure out, like, okay, all of these people that are on the coast are doing these wonderful things. Like if 4% of them return to where they originated from, where are they going? Where is the, are they going to Iowa? Are they going to Alabama? Are they going to Texas? And what does that look like? How does that change that ecosystem to kind of make it a more even landscape, as opposed to a highly polarized coast to coast and everywhere in between? So two probably selfish data points that I'm still looking for, that I will keep looking for.
We won't call them selfish. We'll call them areas of passion. And I'll add in my two, because I love this question. And I think that we need to do more of trying to map the social and capital networks that are connecting dollars between companies and investors, and understanding how that money is actually finding those companies, so that we can have replicable models. And then the second one that I would encourage is getting a better sense of what happens when a company quotably fails or dissolves, but might go on to create something else, or that IP goes somewhere else and the team goes somewhere else. But doing a better job of measuring this notion of failure in entrepreneurship that may actually be the precursor to the subsequent success. So those are two areas that I think we could do a lot more with. And I think we are at time. Gerald is here to play the orchestra music and say no more Oscar speech. But thank you all for joining us. Mary Ann, Brent, and Shana, it's been a pleasure. Gerald, I'll turn it back over to you.
Thank you, Martha. Thank you, Mary Ann, Brent, and Shana. And I'll put in a slight plug for the Kenan Institute of Private Enterprise, because our goal is to actually try to come up with those, or to come up with those data-driven, solution-based outcomes, and to try to, or solution-based recommendations. And so, given the focus on data, and I think we will work towards coming up with those recommendations, and appreciate everybody's support and thoughts. Have a wonderful day, and we look forward to seeing you at our next event.
Thank you all.